more than 50% of my entire net worth is silver eagles. I have a bunch of other silver, and I own 300 ounces of silver for every ounce of gold that I own. And the reason for that is because I allow the gold-silver ratio to sort of tell me what to buy. During the COVID panic, I wanted to buy gold so bad, but that ratio went all the way up to 120. I couldn't buy any gold when silver was selling at such a discount. Everybody wanted to get rid of silver and buy gold for some reason. So I bought a bunch of silver and no gold during that period of time. And it has, my average buying cost on my silver is about $13 an ounce. So I've done very, very well. Gold and silver are the number one performing assets of this century, other than ones that start out at zero, like Bitcoin, the first brand new financial class in hundreds and hundreds of years. It's the number of billionaires. There were a few, I believe there were 7 in the United States, and then there were another 6 back in 1980 when gold peaked at $873. There were another 6 in Europe, mostly in Switzerland, I believe. And now, look at this. You've got there's greater than 600 in these countries, and there's billionaires in Africa now. This is an entirely different world, and all of these people can direct very large amounts of capital at a whim. They can just, so if something comes along that scares the entire world, billions upon billions of dollars can be suddenly directed toward gold and silver. Now, for gold and silver to be in a bubble, somebody has to own it. Gold portfolio share by type of investor, and thanks to Craig Henke of TF Metals Report, fund managers say gold is a crowded trade. Actual fund manager positioning, 3% for hedge funds, all the way down to 1.3% for pension funds. So this really needs to also be resolved. Somebody would have to own it. This all has to get up to like 10% or more for gold to come anywhere near approaching being done, being in a bubble. Now, so Health Ranger, says somebody has inside information about gold revaluation looks like.
What if I told you one of the world's top precious metals experts has over 50% of his entire net worth in silver, not gold? And even more shocking, he believes gold could eventually reach $75,000, even $145,000 per ounce. This is exactly what Mike Maloney is warning about, and the reason why might completely change how you see money, debt, and your future wealth.
Gold reserves as a percentage of government debt. You can see gold going up, and then we had the crash. This is the Great Depression, and the debt did start going up during the Great Depression, but for a while, everybody was redeeming. There were the bank runs of the early 30s, and people didn't trust the paper dollars anymore, and they were asking for real gold. And that's when they, in 1934, nationalized it. In 33, nationalized it. In 34, they call it gold revaluation. It wasn't. They unpegged over a period of a month. They unpegged and repegged, and the market price of gold based on exchange rates around the world changed until it got to $35 an ounce, and then they left it pegged right there. But 51%, if we went to that today, it implies a price of $75,000 an ounce. Gold, under the bread, this is all the extra gold flowing in to the United States while Hitler is doing his save. So this is the gold revaluation of 1934 from $20.67 an ounce to $35 an ounce. This is gold flowing into the United States from foreign countries because they are making preparations for war. They're trying to get their gold into a safe place and so on. And then this falling is all of the U.S. debt that we took on to fight World War II. And so gold, we didn't have as much gold to cover the exploding amount of debt. But look at where we are today. So that was predicting last year $4,800 gold, and we've surpassed that. Then we've got 26,000 an ounce if it goes back to where it was in the 1980 peak. So where are we today? This is old. So this is October of 25. And that's when we hit $38 trillion of debt, implying $145,000 per ounce gold to cover that debt. The debt is still exploding. It is projected that we will have a budget deficit of $1.9 trillion this year. That is huge, 5.8% of GDP. However, they're always wrong. They are always, always, always wrong. Even in the very best years, they make their projections much more rosy than the actual outcome. So I would expect this to be like 6.1, unless we have a market crash. If we have some sort of bad recession, and then the Fed responds by creating a whole bunch of currency, and they subsidize deficit spending for the federal government, then this could go up to 7.5%. This could be 2.5 trillion, 3 trillion. Nobody knows. But I do know that they are always, always wrong, and this projection is always low. All you have to do is just go back and look at the Fed's data and back test it. Jesse Colombo, gold and silver's bull market is still in its infancy. How do you know? Because the dumb money is more interested in selling their precious metals than buying them for now. Now, one of the things where you can see this is the premium that is being offered, the premium or discount that is being offered on gold and silver eagles. And right now, gold and silver eagles, when a dealer is buying them back, they are offering less than spot instead of way over spot. And the monthly sales annualized in thousands of ounces. And so here we are annualizing. This is January data. So we're annualizing January data. But in January, with that big run-up, if you take that times 12, you end up with this pitiful amount. So gold and silver eagles are down, and the public was selling during this big run-up in gold and silver. What was it causing this? Mostly like China getting in on the game. So, in my book, there is a chapter called The Point of No Return. I tried to license this image. It's from a Sinatra album that I own. Very cool. The Point of No Return was the name of the chapter, and it ends with this one chart that wraps it all up. This is the 5-year change in gross domestic product divided by the 5-year change in gross federal debt. And so the critical threshold is $1. In other words, if you borrow $1, how much GDP growth do you get in 5 years? And the growth after World War II, you would borrow $1, go $1 deeper in debt, and GDP would grow by up to $8, but somewhere between $6 and $8 of growth.
Mike Maloney's strategy is simple, but powerful. He lets the gold-silver ratio dictate what he buys. During the COVID panic, that ratio exploded to 120, meaning silver was massively undervalued compared to gold. While everyone rushed into gold, Maloney did the opposite. He went all in on silver. The result? His average cost is around $13 an ounce, and massive gains followed. But this isn't just about smart timing. It's about a much bigger shift happening in the global financial system. Today, gold and silver remain heavily underowned by institutions. Hedge funds allocate just around 3%, and pension funds even less. That means, despite rising prices, this is not a bubble. In fact, real bubbles only happen when everyone owns the asset, and we're nowhere near that point. Now here's where things get serious. History shows that during crises, like the Great Depression, confidence in paper money collapses. In 1934, the U.S. government reset the system by revaluing gold from $20 to $35 an ounce. If a similar reset happened today, the implied price of gold could skyrocket into the tens, or even hundreds of thousands. Why? Because global debt is exploding. The U.S. alone is running deficits in the trillions, and every new dollar of debt now produces less economic growth than ever before. Since the era of Ben Bernanke, the system has relied on printing money just to survive. And that's the breaking point. Even more surprising, while prices rise, everyday investors are actually selling gold and silver, while countries like China quietly accumulate. This is classic early-stage bull market behavior, where smart money moves first and the public catches on last. Maloney calls this the point of no return, a moment where debt, currency creation, and loss of trust all collide. And when that happens, gold and silver don't just rise, they become financial lifeboats.
And then this fall, as we abandon gold in 1971, that's where the direction of this really changes, because the gross federal debt could explode. Gold wasn't keeping it under control like it used to. I mean, they were cheating gold with, the classical gold standard couldn't cheat gold before World War I. But then with the Federal Reserve Act of 1913, and the Fed opened its doors in November of 1914, by the way. That's when they started manipulating the economy, and there was only a 40% reserve ratio. So they're trying to cheat gold, and gold was the big balancer, the thing that kept everything humming along in balance in the global economy. And so they're cheating gold now. But then the Bretton Woods system, and then Nixon takes us, that kept us sort of in line. And then Nixon takes us off of gold in 71, and that's when all of the deficits could just explode. Now, something happened in 2008, and I call it the introduction of Bernankenomics. We create currency. The whole economy is different than it was before Ben Bernanke. We do everything, the way currency is created, the way the Federal Reserve manipulates markets. What has happened since then is for every dollar we borrow, we get about 50 cents of GDP growth, and that is continuing. And so they're going to spend $2 trillion this year in deficit spending. We're borrowing that much extra, going that much deeper in debt, but we're only going to get $1 trillion worth of GDP growth out of it. So we're going to be another $1 trillion deeper in debt because of this. It just doesn't stop. So gold and silver are the safe haven. It's where you run to protect yourselves, and anybody in the industry should feel like they are helping to protect other people. Now, I do believe that bullion comes first. That is the major core. More than 50% of my I never give advice. I tell people what I do. More than 50% of my entire net worth is silver eagles. I have a bunch of other silver, and I own 300 ounces of silver for every ounce of gold that I own. And the reason for that is because I allow the gold-silver ratio to sort of tell me what to buy. During the COVID panic, I wanted to buy gold so bad, but that ratio went all the way up to 120. I couldn't buy any gold when silver was selling at such a discount. Everybody wanted to get rid of silver and buy gold for some reason. So I bought a bunch of silver and no gold during that period of time. And it has, my average buying cost on my silver is about $13 an ounce. So I've done very, very well. Gold and silver are the number one performing assets of this century, other than ones that start out at zero, like Bitcoin, the first brand new financial class in hundreds and hundreds of years.
So the real question is, are we already heading toward that reset? Because if Mike Maloney is right, we're not at the peak. We're just at the beginning. If you found this breakdown valuable, make sure to like, subscribe, and stay ahead of the next big move in gold and silver. Because by the time everyone else realizes what's happening, it may already be too late.